Hello, everyone, and welcome to Halftime Update 2022. I can't believe we're already halfway through the year, but we are. And the Dow has been down. Dow's down 13.62%, I believe, at this moment. At the close of the market today, the S&P 500 has been down over 20%. Today's settling looks like around 19.14%. The Qs, or the NASDAQ 100, has been down, I believe, as much as 34%. It's down 29% this year. And if that wasn't all bad enough, we've got 7 to 10-year Treasury bonds down almost 10%. 20-year Treasury bonds, which we'll talk about later. So U.S. Treasuries on the 20s down over 20%. Treasury inflation-protected securities, which you would think would be doing well because of the way that they're named, inflation protection, those are down almost 8%, and then junk bonds, or high-yield bonds, in other words, are down more than 14%. The only place to hide this year has been in energy, commodities, certain commodities, I should say, energy commodities specifically, and the U.S. dollar, believe it or not. So we're going to get into a bunch of different things, a bunch of different charts, but first, let's just jump in and share a little bit about our contact information in case you want to get a hold of us. You can find us at libertaswealth.com. You can also find us on Twitter at LibertasWM. You can find me on Twitter. I kind of go in spurts, kind of like a roller coaster. I'm up and I'm really active, and then I'm quiet for a while. But I'm at Adam Koch. I'm also on Instagram at Financial Surgeon, and then we're on Facebook at facebook.com/Libertas Wealth. There's our information up on the screen for those of you that want to shoot us an email. If you want to get a hold of us, if you'd like to set up an appointment to get a second opinion, or even just set up an intro call just to get to know each other and see if there's something that we might be able to do to help you with your retirement planning and your portfolio, your investment portfolio. I always like to start with a quote. I love quotes. I collect them. And today's quote is very applicable considering the market we're in right now. It's by Van Tharp. He's an author and a trading coach. And Van said, "A mistake is when you don't follow your rules. And if you don't have rules in trading, then everything you do is a mistake." And that is so true whether you're managing a tactical trend-following model, or if you're managing a buy and hold sector rotation model. At our office, we do both. But all of these models, all of these investment portfolios need to have rules, and those rules need to be followed. Because if you don't have rules, as Van says here, everything you do is a mistake because there's really no direction. It's kind of like trying to drive, as one of my early mentors said, it's trying to drive backwards through a cornfield, looking at your rearview mirror with the lights off. Not going to make it very far in this world. When it comes to retirement planning and investment management, driving that way, we have to look at our instruments. We can't just use one instrument. We have to use a conglomeration of instruments. We have to build evidence as to whether the market is bullish or bearish, and we have to always be on the lookout for times when that analysis might change or when the analysis is wrong. In other words, if things are bearish right now, if the trend is down, we always want to be looking for different hints and evidence that things are turning around and that the trend is changing. So another thing I wanted to start with here, J.C. Peretz, my good friend, he posted this from by way of Steven Suttmeyer, and it's all about Bob Farrell's 10 market rules to remember. And Bob, he started at Merrill Lynch back in the 50s. He was originally a fundamental analysis, believe it or not, but he quickly realized, like a lot of us do, that there's a whole lot more to stock prices than balance sheets, price-to-income ratios, income statements, price-to-book ratios, and all the fundamentals that some people look at. And go figure, but Bob Farrell became one of the greatest, most legendary market technicians of all time. And here's his 10 market rules to remember. Rule number 1, markets tend to return to the mean over time. And that's when we're talking return to the mean, we're talking the ups and the downs. There is a mean reversion there. Rule number 2, excesses in one direction will lead to opposite excesses in the other direction. Kind of like when there's a breakout, sometimes that breakout will turn into consolidation. If there's a breakdown and things become very oversold, kind of like rule number 1, there might be a reversion back to a mean, whatever that mean might be, given the investment in question. Rule number 3, there are no new eras. Excesses are never permanent. So things don't really change, or as Mark Twain said, the market doesn't it repeats itself. It's not exactly the same, but it sure does rhyme. So we're not looking at an identical market to any other market in history, but this market is going to end up looking like something we've seen in the past, perhaps maybe in the 1960s, early 1960s. But I digress. Rule number 4: exponentially rapidly rising or falling markets usually go further than you think, but they do not correct by going sideways. So usually when markets go up fast or down fast, they usually correct by coming back down, or if they go down fast, they correct by going back up. They usually don't correct by chopping sideways. Rule number 5: the public buys the most at the top and they buy the least at the bottom. Or said another way, humans are not very good investors. They have a tendency to fall victim to rule number 6, which is that fear and greed are stronger than long-term resolve. It is just extremely difficult. Humans, we have this thing called recency bias. We have an issue with patience. As mentioned in the quote earlier, the Van Tharp quote, many of us don't have rules. And if you don't have rules, it's really hard to stick to anything, because instead what you're doing is you're looking at the news or watching CNBC, and these things are not going to tell you how to invest your money appropriately. Rule number 7: markets are strongest when they are broad and weakest when they are narrow to a handful of blue chip names. What that means is that when the market is strong, that means a lot of stocks are going up. In other words, it's not just a stock market, but a market of stocks. And when we have a strong market, then we have a lot of participation across the broad market landscape. When markets are weak, on the other hand, you have very narrow participation. You have very few names that are doing well. In fact, when this rule says a handful of blue chip names, what it's referring to specifically is kind of the end, or call it the topping process of a market, which is what we saw toward the end of 2021, when the only things going up were the biggest biggest mega cap names, and it was just a handful of names going up, pulling the indices higher. Rule number 8: bear markets have 3 stages: sharp down, reflexive rebound, and a drawn-out fundamental downtrend. So these stages, sharp down, a reflexive rebound is kind of what we're waiting for right now. So maybe some selling pressure to come in, panic selling we'll call it, and we're waiting for the market to find a bottom right now. Rule number 9: when all the experts and forecasts agree, something else is going to happen. And this one's funny, because even we're talking about experts here. We're talking about the people that you see on the news, finance. When I say news, I mean financial news. When these people are all agreeing on something, what happens is investors have a tendency to want to follow them. When in reality, what you should be doing is looking for something that counters their opinion. And then rule number 10: bull markets are more fun than bear markets. And I think that one kind of goes without saying. So I thought that was a lot of fun to share. JC, thank you. If you're listening, thank you for sharing that one with me. And I thought that was a really fun one to kind of pass along here. So let's get right into it. I'm going to do things a little bit backwards today. And we're going to start by talking about digital assets. So we're talking digital, cryptocurrencies, Bitcoin, Ethereum, whatever you want to call it. In this case, we're looking at a Bitcoin chart. Bitcoin, we're on the far left over here. We're looking at the highs from December of 2017, and that's where we're sitting right now. So in other words, Bitcoin has now fallen quite a bit from the high 60,000s down to below 20,000. I tweeted back a few weeks ago that if we broke through this floor of support, of potential support at the time, and after this consolidation over here on the right, that there was a high likelihood that we would break down and we'd probably see 20,000. So that's unfortunately what happened for the crypto bulls, those who own Bitcoin. We did see a breakdown, and now we're sitting right here on this little high before the big breakout into 2021, which also corresponds with the high from late 2017. This needs to hold. In order for Bitcoin to find a bottom, this needs to hold, even if it falls below it for a moment. When I say moment, a day, 2 days, 3 days, it needs to pull back above that line in the sand. If it doesn't, the next logical area of potential support for me would be the 2019 highs right here in June, but that's at 14,000, which is obviously another pretty big drop from a percentage standpoint. So these are the levels I'm looking at. I have no interest right now in owning Bitcoin. It's not something that we have our clients in. It's not something I would be promoting. In fact, I have a really, really good friend in Colombia who reached out to me literally just before I started recording this and said, hey, is it now a good time to start dipping our toes into buying some of these crypto names? And the answer is no. I think it's too early. I think we need to let things kind of play out here. Otherwise, what we're doing is we're just trying to catch a falling knife. You never want to catch a falling knife. You want to wait till the knife hits the ground and then pick it up once it's settled. Otherwise, we could get our hands cut up. Second one I want to look at is the Ethereum. Here are the 2000, technically 18 highs. So Ethereum climbed to its, at the time, all-time high after Bitcoin did. So you can see here right at the beginning of 2018 is the line in the sand, just like with Bitcoin. Same story on the previous chart. And we're already below those levels. I don't like that. And honestly, when I look at this chart, there really is no other short-term levels in the sand from a price and technical analysis standpoint that tell me we might settle. When I say we, the Ethereum might settle. I don't own any of it. Our clients don't own any of it. But right now, here we are, Ethereum earlier today settling in about 1,097, almost 1,100. And for me, the next logical point in the sand would be this red line right here. This is where we had former resistance above our head, so a former ceiling where the Ethereum bounced and hit that ceiling and then broke through it, broke that back down, and then hit that ceiling almost 2 times here, broke above it. It held that previous ceiling, which then becomes support, and then it broke out. And above, of course, its 2018 highs. So first thing that needs to happen, and for those who own it, is you got to see this thing get back above that line in the sand. If it doesn't, that's not good. In fact, right now, I'd be pretty defensive. If I were an owner of Ethereum or Bitcoin for that matter, I'd be pretty defensive right now. One of the worst things you can do is hope it comes back, think it's going to come back. You will find research that supports your opinion. So if you want it to go up, you will find research online that says it's going to go up. But I could also find 10 other articles that tell you it's going to go down. So instead of reading articles and trying to find prognosticators and people who are trying to predict the future that you want, instead I would just follow price. And what price is telling me right now is that this trend is very much down. We're below the 2018 highs. We've got falling 50-day moving averages, 21-day moving averages falling, and I don't know where we're going to bottom here. I'd like to see this come right back up for all those people who own Ethereum and other digital assets. These two big bad boys in Bitcoin and Ethereum, if they come back, I think they'll carry a lot of the weight of the other good, legitimate cryptocurrencies with them. If it doesn't, however, then Bitcoin comes down along with Ethereum, and this is the line in the sand that I'd be looking at here, this red line. If we look at other asset classes and we kind of compare them to each other, so this is not having nothing to do with crypto, this last 12 months, the best ranked asset class is commodities. Commodities have done really, really well, largely on the back of energy commodities, but there's also been good movement in things like soft commodities, grains, and so on. The next best asset class is the 1 to 3 month T-bill, which might as well be money market. Below that is the S&P 500, followed by small caps, the small cap index. International stocks are second to last, and down here in the basement of all things, it's the asset class that most of us think is supposed to be safe, and that's 20-year Treasury bonds in this case. So bonds are in the basement as the worst performers over the last 12 months. When I look at my dashboard, or my pre-flight checklist, as I call it, kind of stole that from Dave Keller, the name anyway, but this is a conglomeration of indicators that I've put together over the years with other fellow technicians. And here on the left, we've got the short-term trends for the S&P and the Qs, all down across all time frames. We got the intermediate term trend indicator, S&P Qs down, long-term down. So on all indicators right now, the trend is down, and it's been that way for a few months now. When we look at shorter term indicators and other indicators that I follow, these are more technical indicators having to do with MACD, momentum, volatility, and so on. There's very, very little evidence right now suggesting that there is a long-term or even intermediate-term bottom taking place. I think the market's trying to bottom, but we're in the seasonally weakest months of the year right now. The market tends to struggle through the months of May into Halloween, and the worst 2 months of the year coming up are going to be August and September are typically pretty tough. July tends to be a decent month, which I'll show you here in a little bit. And what we want to see is we want to see the market buck seasonality. In other words, we want to see what historically would be, which is for the market to not do well in this next few months. We want to see it buck that trend and start to bottom out and find some relative strength in the S&P 500 here domestically in the U.S., the NASDAQ, and so on. When I look at the S&P specifically, one of the things that I've been pointing out on Twitter is, and LinkedIn, I've been posting a couple things where even though we see a pretty obvious downtrend in the S&P, we've got lower lows, lower highs across the board. We have a falling 200-day moving average. In other words, this red line is the average movement of the S&P over the last 200 trading days. That's sloping down, and the S&P, of course, is below that, which is not good. However, most recently, we've started to see this momentum indicator. It's called RSI, Relative Strength Index, not to be confused with relative strength, but the Relative Strength Index indicator is telling us that even though we're seeing lower lows here, it is not crossing below the bearish level of 30. That's a good thing. And when we see levels holding like this above bearish lines in the sand, like 30, if it were below that would be bad, kind of like back here in early 2022. When we see lines holding like that while price is going down, that's called a divergence. In other words, a bullish divergence in this case. In perfect world, we'd see higher lows, but even so, we're not seeing negative numbers here just yet, and hopefully we won't, especially since all of us want to see the market doing well and not doing poorly, of course. Some breadth indicators, looking in at the internals of the market, kind of like taking an x-ray of the market. Here's the market up top in the S&P 500. In the bottom pane, what we're seeing is the percentage of stocks within 20% of their one-year high. And obviously, this is some negative evidence. We're not seeing a whole lot with the exception of this last, call it 3 weeks, and that doesn't really mean a whole lot to me yet. We're not seeing a steady trend or increase in trend or bottoming yet that tells us that the percentage of stocks within 20% of their all-time highs is increasing. We definitely don't want that decreasing. So right now, only 32% of stocks in the S&P 500 are within 20% of their one-year high. We want to see that number getting bigger. Another breadth indicator here. So I mentioned earlier how the S&P itself has not fallen below the RSI reading of 30, the bearish reading of 30. What we're seeing here is the percentage of stocks in the S&P 500 that are below that bearish reading of 30, and it's only 1%. That's good. So you don't want to see big high numbers like this. So on one hand, this is positive evidence, is that we're not seeing a whole lot of stocks in the S&P below that bearish level of 30. However, if I go to the next chart, this is the percentage of stocks above 70, which is the bullish level. We want to see the S&P itself as an index, and we want to see stocks in the S&P going above that level of 70 on RSI. And if I'll just go back to that chart briefly so I can show you what I mean, we want to see this right here. So in late October, early November, we saw the momentum of the S&P going above 70, which is very healthy. What we want to see in a healthy market is the RSI, in this particular indicator, trading between 30 and 100, and really ideally between 40 and 100. In a weak market that's very bearish, very negative, typically what the market does is it trades between 70 and 0. So again, positive evidence here that even though the market's been going down over the last couple months, we're seeing RSI hold. And again, if I go back to that chart, we're seeing the percentage of stocks above 70, not good, that's 0, but at the same time, if I go back, the percentage of stocks below 30 on RSI 14 is also very small. So we're kind of in the middle right now, I guess. And that's what I might suggest is something that might, it's evidence that maybe the market is trying the initial stages of finding a market bottom here. Next, this is just the S&P 500 in price. We're looking at levels, support and resistance levels here. So obviously, we've seen the market go down. This is the summer highs of 2020, which is, I think, a level we've already almost hit. Now, whether or not that level holds or not remains to be seen. But right now, that's kind of what the market's looking at. And if we hold above that line, the market could kind of chop and build a base here, and we could see higher prices if we can make it through the rest of the summer, through September, and then into the midterm elections when that level of uncertainty goes away. The market hates uncertainty, so if we know who wins the midterm elections, or who is going to win the elections, when that becomes very obvious, that uncertainty goes away. The market tends to like that. And even as I'll mention later, what it likes even more is gridlock, and we'll talk about that a little bit later here. But right now, this is the first line in the sand that I'm looking at. If we can't hold above that line over the course of the next several weeks or months, then the next logical line in the sand for me would be the COVID highs, going back to 3,400 on the S&P. So that could be a logical place where the market might come down and bottom if it can't hold the level at 3,600. I mentioned in my quarterly screencast back in April the Ark Innovation Etf, which is run by Cathie Wood, rather famous portfolio manager, very well known and respected in the community. And so far, just since early 2021, her portfolio, and this is as of earlier today, was down about 73%. So this is a market that has not been friendly to technology. It has not been friendly to growth investments, and this is evidence of that for sure. So right now, anybody who owns this particular investment has not only gave up their gains from COVID, but probably gave up a little bit more than that, depending on when you bought it. When I scan back and look at a proprietary indicator that I use, or a scanning tool that I use to rank the strength of different investments, what we're looking at here is international stocks. And I'm pulled them up first because, some people might think, well, if the U.S. isn't doing well, maybe we ought to look overseas. Well, when you look overseas at the top decile, this is the top 6 here within this top decile of performing investments overseas, Chile is the best ranked investment, and it's down. In fact, the top decile's average performance is down. So we can look at Saudi Arabia, Brazil, Portugal, UAE, Hong Kong. All of these are down in the top decile, and you can go down through the second decile, which is usually, that's relatively strong stuff. These are what I call the playoff teams. This is what we want to own. Is we're never going to buy the Super Bowl winner, but we want to own the playoff teams. And this is if we were invested internationally, these are the playoff teams we'd be looking at: Turkey, Indonesia, Brazil, Nigeria, China, Mexico, and so on. But when you look at the bottom 2 deciles, it gets really, really, really ugly. You can look here: Israel down 32%, Netherlands 32%, Germany 34%, Austria 34%, Egypt down 38%, almost 39%, and of course Russia on a trading halt down 81%. Now let's go back to the U.S. The U.S. looks a little bit better, but not a whole lot better. It looks a little bit better. Here we have energy, which has been the best performing sector. And if you drill down into the energy sector, there's other subgroups, or what are called industry groups, that have done well, like oil and gas exploration. And those sectors have done well. Even small caps, even though small caps are tend to be a little bit more aggressive. Small companies versus large companies, being blue chips, tend to be a little bit safer, or at least perceived as safer. You can see here that even small cap energy has done pretty well this year, considering the fact that the market has done so poorly across the board when you look at the major market indices. But as soon as you get out of the energy sector and you get into oil refiners, which are down, solar down, I'll skip these consumer staples. So this is the stuff we need: razor blades, soap, stuff we need to, Procter and Gamble type stuff. But in MLP, pipeline type stuff, healthcare down, insurance. And here's more consumer staples, easy for me to say. Low vol, when you see low volatility, you would think, okay, low volatility means low risk. Well, not low risk, it just means low volatility. It doesn't mean it can't go down. So the top 2 deciles in the market are still really struggling. And then when we look at the bottom 2 deciles, you can see what's doing the worst. And you can go from the top to bottom here: auto index, robotics, social media, semiconductors, private equity, the Innovator IBD 550, which is the top 50 growth stocks by Investors Business Daily. Here's another ARK fund, Cathie Wood, genomics down 37%. Internet, IPOs, AI, online retail, innovation, transformational data sharing. So this is blockchain, Bitcoin, obviously, BITO, and then cannabis being the bottom performer here in the bottom decile. So not looking good. And then when we look at the bond market, so if we switch gears and we look at bonds, well, Well, but bonds have to be helping us, right? If we've got some money invested in bonds, then maybe that's helping to make our portfolio not feel the pain so much. But nope, that's not the case. Here's the bond market going back almost 2 years. Well, yeah, beyond 2 years at this point. So we're going back all the way to July, or I should just say summer of 2020. And the bond market overall is down 14%, as represented by the AGG, the iShares Bond Index. If we look at corporate bonds here in the U.S., as of this morning, over the last couple of years, down 27%. And I already mentioned treasuries earlier, but if we go back 2 years ago, the 20-year treasury bond is down 31.5% as of this morning. So you've got U.S. stocks going down. You've got international stocks going down. We've got bonds going down, and not just a little bit, but some of the worst bond performance, and it could be this year, could end up being the worst year for bonds in U.S. history. We'll have to see how it all pans out. But if things don't start to get better pretty soon, that's what we're going to see at the end of the year. And so things have not looked good in terms of trying to find some place to hide. So as I mentioned earlier, the best place to be really has been invested in commodities, which I always joke is like the jalapeno you put on your food to make it a little bit spicier. But of course, nobody wants too many jalapenos on their food. Otherwise, kind of freak out if your whole portfolio isn't invested in jalapenos. Not literally, of course. And then the other thing would be the U.S. dollar, which is not something that normally portfolios are allocated to. So when we're looking at this, you can see here down years from 1977 to 2022. Charlie Bolello said total return for the stocks for the first half of the year, down 7.2. 1977 all the way down to 2018, down 4.4, and then this year down 20. And you can see where bonds are this year. And when you compare that the bond market to the stock market going back to these bad years, you can see that in 1981 the market was down 4.9, but at least you had bonds helping to cushion the blow. In 2000, the market was down 9% during the beginning of the tech boom bust, and bonds were up 11.6. Even in 2008, when the market was down 37% during the mortgage crisis, you had the bond portion of your portfolio helping to bring up, or at least help cushion that blow. But this year, we have stocks down, we have bonds down, and so we have the average 60 portfolio. If all your money were just invested at 60% S&P, 40% AGG, then you'd be down 16.1%, which is pretty typical right now for your typical call it 60-40 balanced portfolio, if you will. So here I mentioned energy. Here's oil. Oil, ever since the COVID bottom, when literally oil was trading below zero, believe it or not, we've started to see oil going up in value. And just recently, today was a bad day for oil. Some inflation concerns, but now we're seeing just kind of a pullback or consolidation within an uptrend. So I don't see right now any threat to this uptrend. Of course, I saw something different on CNBC, people calling for $53 oil and $45 oil, and I'm not in the business of predicting. I can't remember who said it, but predictions especially difficult, especially when it comes to the future. So I try to stay out of that game. I try to look at the markets, let the markets tell me what to do, and then I try to react to that in the best way possible for myself and our clients. So that's oil. Here's the commodity index. This is DBC. So this is a basket of energy commodities, which would include oil, gas, natural gas, gasoline. It includes soft commodities, cotton, palladium, platinum, precious metals, gold, silver, and so on. Grains like corn, soybeans, wheat. So this is a basket of all kinds of commodities weighted in different ways. And you can see, just like oil, or very similar to oil, we've got an uptrend off the COVID lows, and just kind of a pullback right now, or call it a correction within an uptrend. So again, I don't see a big trend change yet, but we'll have to see how this plays out and whether or not we can hold this uptrend or not. This is the year-to-date total return for the S&P 500. This is Jim Bianco posted this, and here's this year. So you can see here, as of 6:30, the close of the market on June 30th, S&P 500 down 21%, we'll call it, and then this is every other start to the year in history, which I thought was a really, really cool chart. So you can see the worst down here, 1931 down 47%. The best, 1954, up 45%. So we're halfway through the year. Obviously, there's not a whole lot of other lines below where we're at this year. And what that tells me, if I go back to one of Bob Farrell's rules, let's look at that real quick, just for fun. So if I go back to Bob Farrell's rules, let's see here. Excesses in one direction will lead to opposite excesses in the other direction. Let's see, what's another good one? Rule number 1, markets tend to return to the mean over time. So just because things are bad and really because we'll call it one of the worst markets we've seen doesn't mean it has to keep going down. In fact, if you just draw a line here, there aren't a whole lot more markets that went down and ended lower. So could that be the case? Of course. Of course we could see the market go down further. But what are we seeing in this country? Do we have an attack on U.S. soil right now? Do we have military activity here in the United States? No. Do we have high unemployment? No, we don't. Do we have a weak dollar? No, we don't. Do we have inflation issues? Arguable. I'm probably getting yelled at by some people on the screen right now. I think we have a supply and demand problem. I don't think it's an inflation problem. Yes, prices are going up, but to me, inflation is when in the case of the U.S., inflation is when the currency of a country goes down in value, which causes prices to rise because the value of the dollar in this case goes down, creating a situation where it takes more dollars to buy the same stuff. What we actually have is the U.S. dollar going up. It just broke out above multi-year highs today. And to me, that's not inflation. I think what we have is a supply and demand problem with a lot of products, things made in factories overseas in different areas where due to COVID, zero COVID policies, that countries have continued to shut down factories every time there's a single case of COVID, even though those cases are not that severe anymore. And what we're starting to see just last week, actually, China announced that they're considering doing away with the zero COVID policy. That would be huge for the supply and demand equation. That would help get factories back to work overseas, see more products being made. Question I had from a client the other day is, do you think it would be good now that we're seeing more manufacturing coming in the United States? Do you think we could change that by having more manufacturing here? The answer is yes, but not fast enough to fix this situation we're in right now. It would take way too long for companies to set up shop, build warehouses, hire people. By the time all that was done and production was actually occurring, we'd be out of this mess by then anyway. And so, yeah, I don't want to go on too many tangents here. There's so much to talk about, though. Similarly speaking, here's the Dow Jones. So that was the S&P. This is the Dow's top 10 worst first half starts versus this year. You can see in black, this is where we're at, which is almost right in the middle. You could even argue that looking at the beginning of July or at the end of June, we're toward the top of the worst starts, believe it or not. So things could be worse. We could look like this huge smiley face here in this chart, which obviously is not a good thing, right? Here's another look. This is the worst U.S. equity drawdowns from 1928 to present. And you can look again. Here's where we are, 2022, which is kind of sitting close to where we'd be right now in terms of number of trading days. 126 trading days through the year, halfway through the year, almost one of the worst. And then here you can see Black Monday, by the way. So a couple really, really short ones. COVID. Fastest drop in U.S. history by a long shot, 22 days. But these are all the big, huge, worst equity drawdowns ever in history, and kind of where we're sitting. And I've shared enough bad news. Let's share some good news. When this is from Mark Minervini. He posted this. Obviously, Dow Jones Indices, National Bureau of Economic Research is where it came from. But Mark Minervini posted this table, and I thought it was really cool, so I thought I'd share it. This is in the first column here. It's kind of messy. I don't want to say messy. It's just not easy to read. So first column is year-to-date. In this case, this was the 16th of June, so this is not through this past week, but through the 16th was when he posted this. So through the 16th of June, 1932, the market was down, to call it 37%. 1940, down 20. 62, down 22%. 1970, down 17.3. And this year, the market was down 23%, we'll call it. From 6/16 or June 16th through the end of the year, in each of those cases, you can see in 1932, the market was up almost 30, we'll call it 34.5%. It was up 6% in 1940 through the end of the year. 1962, it was up 13%, and in 1970, it was up 21% through the end of the year. That turned the full year performance, and in case the first three were still negative, break even in 1970, and you can see when the bear market ended and whether there was a recession or not. So there was a recession in the case of 1932, but we had a huge bounce, a huge mean reversion. There was no recession in 1940, and we have a mild bounce, no recession in 1962. I'd say a mid-range bounce, and then we had a recession in 1970, but we had a big bounce. So there's all kinds of ways you can slice and dice these statistics. But this year, even though it's a small sample size, we're only looking at 4 other years, but we're looking at 23%. So what's the rest of the year going to look like? Is it going to be positive? History would tell us with a 100% win rate that chances are it's probably going to be positive between now and the end of the year. But anything can happen. But that's what the numbers are telling me. And I'm not going to just give you one. I'm going to give you more than one. The next one we want to look at is from Ryan Dietrich, my good friend, head of technical analysis at LPL Financial. And here we have bad starts to a year at halftime don't always mean more trouble. So whenever the S&P 500 has been down more than 15% at the end of June, going all the way back to 1928, here are the year-to-date returns. So this is every time the market's been down more than 15% at the end of June. 1932, down 45. 1939, down 17. Down 20, 23.5, 21, and 21% this year. So when we look at the year-to-date return, this was as of 6/21, so June 21st, the S&P 500 return through the rest of the year was up 56, up almost 15, up 6, up 15.3, and up 26.5%. Again, 100% win rate with an average gain of 23.7%, with a median gain of 15.3%. So I would look at a table like this and say, for those of us that are fully invested in the market, and at our office we have portfolio models that are strategic, call it sector rotation models that stay in the market, but they rotate out of the bad teams and into the playoff teams throughout the year, just constant rotation, staying with strength, staying with the playoff teams. And if you're 100% invested in your portfolio and you're sitting here going, I think I ought to sell now because I've been watching the news and it's freaking me out and the world is crazy, you'd be right, by the way, and that the world is kind of crazy and there is a lot of crazy stuff going on, but we have to let all that noise, we have to keep that noise from getting in the way of our investment decisions. We have to stay prudent. We have to look at price, trend, volume, momentum, and we have to stay invested in the strongest stuff throughout the year. I keep calling it the playoff teams. And then if you're in a tactical model, or if you're a more tactical investor where you're getting part of your money out of the market, raising cash, sometimes getting back into the market, that would be a trend following model. So in our trend following models, we're pretty cash heavy right now, and we've been cash heavy for a while now. But we got to start looking at this market and looking at these statistics saying, at a time like now when things have been, the market has gone down as long as it has, and as deep as it has, we have to start looking for evidence of a bottom. We can't sit here and start wanting to throw our hands up in the air and want to give up at this point. I told you I'd give you more than one. This one's a little blurry. My apologies. I'm trying to remember, who was this from? Oh, man. I think this was Charlie Bolillo. I think Charlie posted this, but I just want to make sure I'm giving credit to who credit's due. So these are 15% quarterly drops for the S&P 500. So since World War II, every time the market's gone down 15% or more in a quarter, like this past quarter, down 17% at the time that this was posted, this is the average gain for the next quarter and the next half of the year and then the following year. So you can look at this. Market's down 18.83% in 1946 to end that quarter. The following quarter it was up 2.25%, we'll call it. The next half of the year is up 1.4. The next year it was up 1. Pretty tepid. But June 1962, that quarter ended down 21.28%. The next quarter it was up almost 3. The next half of the year it was up 15.25, and the next year was up 26%. And you can look at all these numbers. I don't want to read through all of them because this is not a podcast. You can see the screen. You can look for yourself. But December of 2008 on this is the only one in the sample size. Again, not a huge sample size, but large enough, I think, to draw some conclusions. In December of 2008, we got 22.5% decline in December of 2008. The next quarter, it was actually down. This was the mortgage crisis, so it was down almost 12%. But the next half of the year, up almost 2%. The next year, up 23.5%, we'll call it. So, again, more evidence that just statistically speaking, that once we've been in a bear market, and by the way, the reason they're calling bull markets and bear markets, some of you might know this already if you've been watching or listening to us long enough. Bull markets attack with their horns from the bottom up, and so bull market, think up. And then bears attack with their claws from the top down, which is why they're called bull markets and bear markets, by the way. So, but anyway, once we've been in a bear market like we have now for more than 6 months, this is a time when you just need to start looking for hints of a bottom. And speaking of hints of a bottom, small traders, speculators are betting on a decline like never before. This is from Sentiment Trader. This is just research that I subscribe to. You can see here that the pandemic lows, when a lot of puts were being purchased to basically insure against a further decline in the market, we're at pandemic lows, beyond pandemic lows at this point. You can go back to 2009, you can see that people were buying fewer puts. In other words, fewer people and fewer shares of insurance to insure against a further decline in the market. Fewer of those shares were being purchased in the middle of the mortgage crisis than there were during the pandemic, at the onset of the pandemic, I should say, and now. Now, you could argue there's a lot more people buying options now than ever before, perhaps. But bottom line is, this is evidence that we're getting close to a bottom, or at least I think we're probably closer to the end of this than we are the beginning. I could be wrong. The market could tell. We could see Russia invade 3 other countries, and that would change everything. But that wouldn't be my fault. I can't predict the future. So what I'm saying is, looking at the evidence that I'm staring at today, that it looks to me like we're probably closer to the end than the beginning, and we need to start looking for a bottom. This is, again, put call premium, so put call volume, premium. You can see this number up here at 1.25 is where we've closed in on. Other times when that's occurred was at the end or toward the end of the global mortgage crisis, and then you can see it happen 3 times when the market was bottoming back in 2002, 2003. When people were really basically very pessimistic and trying to bet against the market going up. And then when you can look at these numbers here down in the bottom table, you can see the return after these signals were hit. So in other words, after put call premium hit these levels in the past, you can see what the return of the market was, the S&P 500, 1 week later, down 3.5, down 1, up 1.5, up 12. You can see 2 weeks later and go all the way across here and see that 2002 was the only year where 6 months later the market was down. Even 1 year later it was up 2.3%. But the rest were all positive, with the exception right here, 2003. It was down 0.2%, we'll call it, a month later. So again, more positive evidence. This is another indicator when the breadth, so in other words, participation, the percentage of stocks above their 50-day moving average, reaches this level down here. And you can see how many times it's happened in the past. So this is, in other words, when the market has gone below, excessive pessimism would be below 30, so below 30 right here. And then these really low numbers, where, again, percentage of stocks below their 50-day trend, 50-day moving average, and then what the market did 1, 2 weeks later, 1 month later, 2 months, 3 months, 6 months, and 1 year later. And across the board, when you look at the average returns, they were positive. When you look at 1 year later, positive. And you can see the win rate down here it leans positive for sure. Call it 2/3 of the time. 3 months and 6 months later, it's positive. And a year later, 100% of the time, it was higher. That doesn't mean that this can't be the first time that it's not higher a year later. But I keep going back to this. We don't want to be pessimists. We don't want to bet against the U.S. economy or the U.S. stock market, because the market has an upward bias. I always like to bring up Newton's law at a time like this. Newton's law, an object in motion must stay in motion until acted upon by an equal or an opposing force. So right now, the market is in a downtrend, and Newton's law says that in order for this market to go up, we have to have an excess of buying pressure, buying power, and we need to see selling pressure decline so that trend changes. We need to see an opposing force act on the market, causing that bottom to form and for the market to start going up. June, some more good news here. June tends to start off the month a little bit weak on average, but then toward the end of the month tends to do well. So this is just historically speaking and seasonally speaking. This goes back to 2001. So I keep saying June. I've been saying June all day. I meant July. I don't know why I keep saying June. I do the same thing with January, by the way. I always, instead of January, I say June or July or something. Anyway, this is from Stock Traders Almanac, just like the prior chart was. Jeff Hirsch came up with this idea earlier this year when we were at the Chartered Market Technicians Conference in D.C., and just brilliant, beautiful looking chart here. I know it might look a little nerdy at the onset, but let me walk you through it here. This is the average return of the market for the Dow, S&P, and NASDAQ here by election year. So it's the average performance of each of those major market indices in each year of the presidential cycle. And you can see right now we are living in a midterm election year. So the average performance you can see here is down, for the NASDAQ, flat, we'll call it, for the S&P and the Dow. And then when we hit that fourth quarter and that uncertainty goes away when it comes to the midterm elections, all of a sudden we start to see virtually all the performance that occurs in the year tends to come in the last quarter, which is when the seasonally strong months begin. And then to make matters even better, what happens is after that fourth quarter, and when we get into a pre-election year, the pre-election year is actually the best year for the market of the 4-year election cycle. So next year, seasonally speaking anyway, should be a pretty good year if seasonality sticks to what it normally does. So right now we're kind of in this weak spot where the market has a tendency from May 1st, we'll call it, through the end of the third quarter for the market to be down. You see the Dow down 1.2, S&P down 1.5, NASDAQ down 5, and then fourth quarter kicks in, call it toward the end of October. We know what's going on with the midterm elections. The Dow has a tendency to go up. On average, going back to, I believe this would be 1950, 19% for the Dow, S&P up 20, NASDAQ up almost 30 on average from the fourth quarter through the first half of the pre-election year, which again, I can't reiterate more, is the best year of the 4-year election cycle. And then the other thing I mentioned earlier about gridlock, this is gridlock. This is not political. It doesn't make a difference to me who wins the midterm elections, but what I can tell you is the market wants Republicans to win, so that we have gridlock. You can see if we have a Democratic president and a Republican Congress, that is the best combination for returns when we go back to 1949 and we look at different combinations of presidents, whether they were Republican or Democrat, and what Congress looked like at the time. So if the Republicans take over Congress come November, then we're sitting in this regime, I'll call it, that is the best historical performance when we're looking at political makeup, and we're finding ourselves in the seasonally strong months of the year from Halloween through May of next year, all while walking into the best year of the election cycle, which again is the pre-election year. If Democrats continue to hold Congress, you can see here Democratic president, Democratic Congress, average return about 8% per year. So not bad, about middle of the road, nothing to be upset about. So I'm not upset about that anyway. So either way, I mean, obviously what we want is, for me, I look at the market and go, I want to see the market go up. So if we can get everything aligning in lockstep to create an environment that is healthiest for stocks, this is what we'd be looking at. And the joke is, the reason why the market does so well in times of gridlock is because politicians can't get anything done. So there you have it. All right. So I mentioned earlier, if you have any questions, please feel free to reach out to us. You can reach us at info@libertaswealth.com. You can also reach out to me online, shoot us an email on our website. You can set up an intro call on our website if you'd like, or you can just email us and we'll get one sent out to you, a link sent out to you to set up an intro call. If you'd like a second opinion on your portfolio, that starts with an intro call. We always just have a quick phone call to get to know each other a little better, understand what what's on your mind, what has you thinking during this market, during these rough times. We tell you a little bit about our process, how we work with our clients, talk about our fees and all that fun stuff. So if you have interest in having an intro call, we'd love to talk to you. Just reach out to us here at the contact info on your screen. You can always call us, of course, 614-543-1350. And as I mentioned earlier, we're on social media all over the place. You can find us on Twitter at LibertasWM. I'm personally on Twitter at Adam Koch. Or on Instagram, I'm on Instagram at Financial Surgeon. And then again, we're on Facebook at facebook.com/Libertas Wealth. And I do a fair amount of posting. I say fair amount, maybe one or two posts a month or so that's kind of nerdy and charty like today. Today was, which we do this once a quarter. This is typically called the quarterly scouting report, but this is the halftime update. We do quarterly scouting report at the end of the first quarter and the end of the third quarter, and then we do market outlook to start the year, of course. So thank you so much for joining us. There's all kinds of information out there, and I really appreciate you taking the time to listen and watch this presentation. I hope you enjoyed it. I hope it was valuable. Please feel free to pass it along to any friends and family you have, and I look forward to talking to you soon.